Welcome, everybody, to this special deep dive into Robertet, brought to you by Heavy Moat Investments and the Dutch investors. Today, we're exploring a business that you probably come across every single week, maybe even every day, without realizing it. Robertet operates in the flavors and fragrances industry, supplying some of the biggest names in the world. Think of Chanel, L'Oreal, Nestlé, or Danone. Think about the perfume you wear, the skincare products you use, and even the flavors in your favorite yogurt drink. There's a good chance that Robertet had a hand in making them what they are. To help us break it all down, I've got a special guest with me today, and he's the founder of Heavy Moat Investments on Substack. And today he is here to share his insights and help us analyze Robertet. Nicholas, are you ready?
Yes, I'm ready.
Let's get this show on the road. All right. Nicholas, can you please introduce yourself? Who are you? Where are you from? And just what are your hobbies?
Yeah, sure. I'm Niklas. I'm from southern Germany, and I have started getting into the stock market at, I think it was 21 years of age in 2020. And since then, I have been exploring my own investment style and basically doing it publicly, first starting on Twitter, which I still do, then switching also on the side to Seeking Alpha, writing there a bit. And since 2024, I've been writing almost exclusively on Substack with my own blog, Heavy Moat Investments. And I try to focus on strong companies with a high competitive advantage in secular growth industries and led by good management. And
All right, perfect. I think we are pretty similar here, and that's one of the reasons we asked you to join on this analysis. Can you tell us, how did you come across Robertet? Because I had no idea of this company before last month. You put it on my radar, and we decided to analyze it together. So how did you come across this company?
I came across Robertet like I do with most of my companies. I like the cloner framework, as I think it was made popular by Monish Pabrai. Basically looking at companies you see on podcasts, on social media, or on analyst portfolios or something like that. So someday I came across it on Twitter, and I looked into it, and I decided to like it. So that's basically how I get most of my ideas.
Yeah, that's a great strategy for any investor, because there are so many companies, and you can get lost in like the absurdness of how many there are. So this is a great way of finding new ones. Let's get started with this French company. Let's introduce the company for a second. Can you give us a bit of background of how Robertet started and just explain very simply what they do?
Yeah, sure. Robertet is a very old company. It was founded in 1875. Back then it was a factory treating flowers and plants. And it wasn't founded by somebody from the Maubert family, but the founder had a nephew from the Maubert family, who he then hired as a perfumer and distiller. And the Maubert family still runs the company and still owns, I think, around 60% of the voting rights and around 45% of shares. So the company still is based in Grasse, the cradle of the French perfumery industry, since 1883. And so basically the company has been under the successful reign of the Maubert family for a very long time. I think it is like 170 years.
Yes, you're totally right. It's over 170 years old, which is
very
ridiculous to think about, right? So perhaps the Lindy effect comes into play as well, where the longer a company is around, the more likely it is to stay around.
Yeah, exactly. And about what they do, the company is supplying all kinds of companies in the basically everything that touches the skin, from perfumes, from food. It all has a taste or a smell, so a flavor or fragrance. And Robertet is specialized on the natural part of the market. They take, for example, a very famous example is the Bulgarian roses. They take their oil, for example. It's a very high value ingredient, and they do that with a lot of very exclusive ingredients, giving the products often a premium and a prestige. So yes, they supply all over the world customers with these ingredients.
Yeah, it's pretty abstract the first time you look into their 10K, but after doing some research, to give the listener even some more examples, if you're looking for a L'Oreal anti-aging cream, it has like a scent to it, but also lavender in body lotion they supply, or the vanilla extract from certain bakery products, or it's in so many different products, and you can't even list them all. So many. I asked investor relations about it, but I never got a response, unfortunately. But I guess they're busy running the company. Okay, let's head on over to how this company makes its money, which is pretty important for a business. Can you explain how Robertet makes its money?
Yes, sure. As I said earlier, they focus on natural ingredients. So the market is split into natural ingredients and into chemicals. Robertet exclusively is natural ingredients. That means they have a lot of ingredients to take care of, and also very critical components. For example, the Bulgarian roses. There are some products, like for example, champagne, who can only be made in a certain region in France. So a lot of their products, the exclusive and premium products, are based in a certain region. So you basically have to get your supply from there in order to call it and sell it as that prestigious product. So the supply chain is very tough, and they have vertically integrated. They own parts or in corporations with some suppliers for critical components.
Am I correct in saying they sell it B2B? So let's say you're a business and you want to sell certain scents or food, and you need a flavor or fragrance, or you need certain raw materials. You go to Robertet, and they supply it or they sell it to you?
Yes, and oftentimes Robertet also collaborates with their customers. They have certain research centers for that. They ask the customer what kind of product you want to do, and then they try to find out what kind of flavor or fragrance they need. So
yeah, that's a good point.
It's not just harvesting the product; it's also like formulating the specific use in the product, and
yeah. They have 31 natural raw materials sites, which they show on the map on their investor relations. And this is basically like the location where they grow, harvest, and source the natural ingredients. Think of flowers, herbs, fruits, spices. And like you said, the research and development centers are a lot more important than I initially thought, because this is where you can collaborate with other businesses to create the perfect scent or the perfect flavor. So they're very specialized in that way as well. It's a lot more difficult than one may think initially.
And also one very interesting thing with the industry. Once you have a product and the molecules and have it patented, you can also leverage that in your new research and development. So the more research you do, the more products you get out there, the larger your database gets, and the easier and the more unique you can do your next product. So
yeah,
that's also an interesting part of the industry.
Yeah. Robertet's revenue is divided into 4 segments. Fragrances, so think of perfume, skincare, and home products. Flavors, think of food, for example, soft drinks. They have natural raw materials, where they sell the plants, flowers, and herbs into oils, for example. And they recently, pretty new segment, health and beauty. It's still not profitable, so that's good to know as well. And most of their revenue, over 80% of their revenue, close to 80% of their revenue comes from Europe and North America, and the rest is divided across Asia, Africa, and Latin America. I think this would be a good time to head on over to the sector and industry, because this was pretty difficult and interesting at the same time. What does the flavor and fragrance industry look like? Is it a large market? Is it fast growing? And perhaps you can share some useful insights on the industry itself.
It's a pretty large market, I would say, but not gigantic. It's around 30 billion, I think. I think it was 30 billion in 2023. It's not a very fast growing market. It's growing at around inflation, maybe a bit more. So the industry is very fragmented. Robertet is only the 7th largest player. And the first 4, I think, are pretty large and a lot larger than Robertet, around 5 to 10 times the size. Most players are in the chemicals and or in the naturals, but Robertet is the largest pure play in naturals. So that's one of the advantages. There are a lot of small companies, and the large players are very active in consolidating industry. So
I did some research on this as well. The largest companies are publicly listed as well, so that's pretty useful to know. So you can find a lot of numbers about the businesses. The largest revenue-wise is, and I think you're from Germany, so it's easier for you to pronounce perhaps, Firmenich?
Yeah, I think it's Firmenich.
Yeah.
But it's from Switzerland, so they speak weird German. So.
Okay, it's about the pronunciation. But the other ones are IFF, International Flavors and Fragrances, around 11 billion in revenue as well. Givaudan, also from Switzerland, around 8 billion in revenue. And Symrise from your country, Germany, around 5 billion. So Robertet is very small compared to those.
Yeah, exactly. With just the 7th largest player, there's also a lot of room to consolidate, and they even were the target of an attempted consolidation. Givaudan and Firmenich used to own around 30% of shares outstanding, I think. And they just very recently, in recent months, sold their shares either to the family or to an investment fund.
Yeah,
that was a very interesting dynamic, and the Maubert family, obviously with 170 years of ownership, did not want to sell, and they tried to do everything to basically stay independent. I think that's also what motivated them to get a CEO that's not from the Maubert family, but an outsider, to try to get more focus from the public markets and maybe also get a higher valuation, because in the end, getting a higher valuation is a good defense against an attempted takeover.
Great points. Absolutely right. And you talked about the industry consolidating. What I read from your analysis is that it's very likely that the largest players will keep acquiring smaller businesses so that the industry keeps consolidating into a few larger players. What are, according to you, the highest barriers to entry into this industry? Is it capital intensity? Is it regulatory requirements? Is it brand relationships, R&D, anything else perhaps?
Yeah, the business is not that capital intensive, at least not on a cash flow measure. On an income statement measure, it's pretty intensive. You have to invest a lot of money into R&D. Robertet invests around 8% of sales into R&D. You need to develop new molecules and new ways to get products to your customer to add value, and that's a barrier to entry. And also, as I earlier said, if you get bigger and have a larger database of research and development, it gets easier to get to new products. Then you also have the regulatory mode. Basically, all products get in contact with human skin or are consumed. So you have a lot of health regulations. Oftentimes, products are also spec'd in. You get approval to produce your product with that supplier. and people will think twice if they want to change the formula just to get a few percentages of margin. Also, a very interesting point is that flavors and fragrances are not a large part of cost of goods sold for customers. Usually they are from 0.5 to 5% of sales. So on a premium perfume, for example, you might have 5% of the price coming from a Robertet ingredient. But on, I don't know, a yogurt from Danone, you have probably 0.5%. So you don't really have a high incentive to switch to get a little bit of extra margin. And also you have the uniqueness of the flavors and fragrances, especially in high value products like premium perfumes again. You don't want to try to get 0.5% better margins with completely trying to re-engineer your scent and having the risk of your product not being liked anymore. So yeah, it gets to very sticky customer relationships, oftentimes with decades of revenues for Robertet and other players, of course.
Yeah, I agree here. Great points, and I think you're already making a little bridge to the competitive advantage, which we'll talk about next. What do you think are the biggest moats for Robertet?
For Robertet in particular, we of course have the barriers of entry we have in the industry themselves. For Robertet, they have the focus on naturals. In our world, people are getting a lot more conscious about what they eat and what they wear. People don't want to have chemicals in their food, and they try to reduce it. So having especially for premium products, having a supplier that has verified supply chains. And I think in the 2023 annual report, Robertet said that 48% of their supply chain is audited, and they will try to get that to as close to 100% as possible. So you have basically the history of the supply chain. You can avoid scandals as, for example, a luxury brand like Hermes. And that's something you want to pay a premium. And yeah, then you also have the vertical integration, which of course also plays into the visibility in the supply chain, but it also helps them have a cost advantage. And especially with the premium ingredients like Bulgarian roses, you have the exclusive access in some cases. So with, on the one hand, the integration, the vertical integration, the focus on naturals and benefiting from the sustainability tailwinds they have. Then you also have the family ownership. I think a lot of the competitors are run by public companies with shareholder interests and trying to appease the market. And Robertet is more long-term focused. They have a 170-year history, and they won't try to cut corners to get the next margin target for the next quarter. They think in decades, and that gives them an edge as well.
Absolutely, yeah. In my analysis, it came down to three modes. You're naming more specific modes here. You're naming switching costs, which I totally agree. The incentive to switch is not high, and they do have pretty significant switching costs. The only question I have here, and perhaps you can help me out, I've talked to my colleagues, and do you have any idea how difficult it would be for a customer of Robertet to switch to a larger competitor, say Givaudan or IFF? Do you have any idea here?
I guess it depends on what kind of product they offer. If it's something like a high luxury product, then it's probably a lot harder. If it's just let's again use the example of a yogurt. If the taste is a little different, customers probably won't care as much. If your $200 perfume smells differently, people will stop buying it. So
great points.
So that's one of the points. Then you also have to figure out what they did to get the scent. It's patented. You would have to re-engineer the process. You would have to find a substitute in a different way to get the same result. You would need a lot of R&D and cooperation with the other supplier. So you have startup costs just to get the same product.
Yeah.
Then you have to get a better, cheaper deal with the other company. And then you also have to go through regulatory hurdles in many cases to get a product launched and reformulated. So I think it's pretty difficult. And most of the time it probably won't wouldn't be a rational decision to change it.
Yeah, I see. And do you have any idea if the other companies are trying to invest in the natural ingredient space more? Do you see any trends here or not particularly?
I'm not sure if any large one in particular trying to lay their focus on it. But of course, Robertet is, while they are the leader, they are not like a monopoly in the naturals ingredients market. So the other competitors are trying to come in, but I think especially with their reputation and their pure play focus, they definitely have an advantage.
I see. Yeah, and the other two modes it came down to was intangibles, which you basically said as well. I mean, you could say a family and management team is an intangible as well, but also the patents and the just to name a few. One thing I thought of, which you perhaps didn't mention here, but the cornered resources mode, I believe it's also here for Robertet because they have access to these exclusive partnerships and sites that the others do not have access to. Do you agree or no?
Yeah, definitely, yes. Especially with the vertical integration. A lot of the most important resources they have integrated vertically, and they basically either own the farms or they have large partnerships. So even getting the product, some customers buy it from Robertet. So even if the customer tries to compete with them, they still have to buy from them.
Yeah, exactly. That's a pretty strong mode. I think it's a good time to head on over to the financials because no business is good without making money out of it. I always tell our listeners that the financials are pretty difficult to follow, so I do recommend checking out Niklas' analysis on Substack or our written report, so you can see the graphs and you can. It's much easier to follow, but perhaps you can name some of the most important financials numbers. What do our listeners really have to know about Robertet's financials?
I think for me, the most important financial KPIs I want to keep track of is their growth. So of course you need revenue growth in the end over a very long time frame. Revenue growth is the most important part of an investment. You also need to look at margins. Robertet has very good margins for the industry. And I also would look at reinvestment. They are investing in R&D, CapEx, and also are doing some M&A. And you want to see them continue to make those investments, and you want to track if they can continue to achieve high returns on invested capital. So those, I would say, are the main focus areas I would pick. And also keeping checks on the balance sheet.
Yeah, it's funny you named the balance sheet. It's pretty healthy. Yeah, there's not a lot of debt here compared to the competitors. And I agree on the KPIs mostly. What I would like to add is that revenue growth is important, but especially the like-for-like revenue growth. You want to see that growing besides the revenue growth, including acquisitions. I also included gross and operating margins, especially looking at them compared to their peers. And like you said, R&D spending as a percentage of revenue appears to be pretty important in this industry. So keeping track of that, I mean, you don't want them dropping it to, 1%, since it's so... it's a pretty innovative industry in a way.
That would be a very red flag if their R&D spend would drop to like 1 or 2% of revenue.
Exactly. Yeah. Just to sum up the financials, in fiscal year 2024, they haven't released the annual report just yet. It comes out in April, but they did release some preliminary results. It appears they're going to earn around 807 million in revenue. Like for like, revenue growth is up 9.6%, which is very good for this company. And like I said, the health and beauty, looking at the segments, the health and beauty segment is still unprofitable. And the fragrances and flavors are the most profitable segments for revenue, which is the largest part of their revenue. So that's pretty good to know as well. And I think you have the essentials for the financials this way. But the financials are being run by a management team. So I think it's a good time to look at their management. What can you tell us about the management team running Robertet?
Yeah, so the company used to be run by the Robertet family. And in 2022, they got a new CEO, Jérôme Bruhat, I think it's pronounced, from L'Oréal. So you have an industry insider, especially in the fragrances segment. And I think it was, as I said earlier, in part of the way to try to appease the markets and get a new perspective. Because there are some prejudgments towards family-run businesses, and people maybe would find it favorable to have an outside CEO, try to get some new wind in. The Mobile family is still running the company, though, from their ownership, and they also have several members on the board and other executive roles. They definitely have enough skin in the game, and the new CEO also got a share package. And what I find very interesting is that he will get 1 million shares upon retirement if he is still with the company at that time. So that gives him definitely a long-term incentive. And I like that a lot more than, for example, what we see in American companies where insiders just get a lot of shares dumped once they get into the position, and then they can just move on once they vest. With this kind of schedule, there is a very big incentive to stay with the company.
That's a great little detail. I think the management team is pretty conservative. Yes. I like the fact that they're family-led. I like the fact that they have a very experienced CEO. I mean, the incentives are aligned. Yeah, and after conducting some research myself, I found that management receives a pretty, I mean, it's not a lot for a CEO, compensation for 500,000 euros a year, which is, I mean, for such a business, not ridiculous. They can get an annual bonus up to 70% of their salary. And their long-term compensation is tied to revenue growth, which we like, EBITDA growth, which is also pretty good since it doesn't include the depreciation and amortization, so it doesn't fluctuate as much. And the CSR criteria, which we haven't mentioned yet. For our avid listeners, I am not a big fan of ESG goals. We usually make jokes about them since there's often bonuses tied to a lot of ridiculousness around ESG goals. But this is the first time that it really makes sense for a company. Can you perhaps explain why ESG is so important for Robertet?
Yes, I generally agree that it's not something I take too much time spent on. I don't want to invest in immoral businesses, but I don't really care that much for most of the ESG incentives. In Robertet's case, though, as I mentioned, their supply chain is a big part of the competitive advantage, in my opinion. And they have the goal to get the supply chain audited. They currently have around 50%. And for example, auditing the supply chain is a good ESG goal. I would assume that's in there. And also just for a naturals business, trying to reduce emissions is probably also a good target. So it does make sense. Also on general compensation, when I started to look more into European companies, I noticed that they generally have a lot lower compensation. Like it's not that unusual to have CEOs from large companies earning just, in quotation marks, just $1 million a year, or euros in that case. And I honestly prefer it because looking at some American companies where insiders get like, on a $5 billion valuation, get like a $50 million equity paycheck every year. And some tech companies, it's not really in alignment with shareholders, in my opinion. And I like that about European companies. Oftentimes, the variable bonus payments also are lower than the normal salary. So that's also the case in Robertet. And yeah, generally, I like the compensation. What I would like to see is some more focus on, for example, return on invested capital or something similar. Just something to also tie the capital efficiency and not just the revenue and EBITDA growth to compensation.
I absolutely agree. And when looking and calculating the return on invested capital myself, it has been dropping over the past 3 years. And I believe it's mainly due to goodwill, since that puts pressure on the ROIC from the acquisitions. But it is still higher than all of its competitors. But it would be good to see the incentives tied to it. But it's not right now. But I don't think it's a red flag.
No, they have been more active in M&A.
Yeah.
And obviously, it's an industry with relatively high valuations. It's a very durable industry.
Yeah.
You have very sticky customer relationships, so you pay higher multiple, for example, compared to a food business. So it's only natural that you have higher goodwill in acquisitions. The big question is if they can make good acquisitions, and I think they are disciplined. That could also be, for example, an advantage, that they don't have to force growth. A lot of the public competitors who are run by more towards the Wall Street expectations maybe try to optimize for single quarters. And obviously, if you need revenue growth, you can just make an acquisition. I think being disciplined in that way is an advantage for a family business. Mm-hmm. But it also makes revenue growth more lumpy. So you probably shouldn't expect a smooth, let's say, 8% per year revenue growth. You will have higher growth years and lower growth years, more so than a company that tries to focus on expectations more.
Yeah, in our analysis, we said that the cyclicality in this industry is pretty low, since it's such a small portion of customers' products. But also the risk of disruption is not really there, since it's pretty fragmented, but it is consolidating. So let's say a very small company has a new invention, it's pretty likely it's going to get bought by someone. And the barriers to entry are significant, in my opinion. It's very difficult to just come in and take over the larger players. So I agree here with you. Let's head on over to the risk and opportunities for Robertet. What do you believe to be the biggest risks for Robertet, and why?
While I normally am not that big of a fan of the whole AI hype, I think in this industry it could be a double-edged sword. I think AI could make the research process easier and faster, and that could drop the barriers to entry in a sense. But it can also help the company. So that's a double-edged sword. I think we should look out for that. Luckily, Robertet is already investing in the area. I think they also made an acquisition, and they have made partnerships. So they are experimenting with AI. And yeah, I mean, the R&D process relies on finding new ways to use products, natural ingredients to make sense. So similar to the efforts in, for example, new medicine, AI could accelerate the process with finding new combinations. So that's an interesting thing. Then also, Robertet, especially as a natural pure play, is requiring ingredients often very localized. And as we can see, if you focus, for example, companies like Hershey's or Lindt, cacao prices are currently skyrocketing. In the last year or so, they I think tripled, or maybe even more at this point. So with climate change, we could see parts of the portfolio threatened. And even if they have ownership of the product, if the climate changes, we could maybe see some ingredients maybe even disappearing. So that's a risk, but I think that's still probably just a part of the portfolio if it materializes, but it's something we should keep in mind.
Yeah, that's my number one risk as well, the dependence on the natural raw materials. it's a huge advantage, but at the same time, it comes with quite a few risks, which makes sense. I'll name the other two I have, and perhaps you can share your thoughts, whether you agree or not. I think competition is a pretty big risk for Robertet, although they are pretty unique because they're so focused on natural. I mean, the industry is dominated by 3-4 large companies, and they have a lot more financial resources to invest in R&D, for acquisitions, to grow volume, production efficiency. And I mean, if they see Robertet is successful, it is only natural for them to pursue Robertet's niche, which they are operating in. And if the larger players are successfully expanding into their natural segment, I mean, they could risk losing market share, or perhaps they're going to get acquired. Although they just got rid of the two larger competitors from their holdings, so it is a bit of it's a lesser risk now, but who knows, right? And my last point for the risk is macroeconomic. Although Robertet does not sell direct to consumer, their clients, luxury brands, food companies, beauty businesses, do have direct customer exposure. So if the economy slows, these customers will experience that, and it will hurt them. So perhaps like a second order effect, it will also hurt Robertet. I mean, consumers tend to cut back on non-essential purchases during tougher economic times. Those are my three risks. Would you agree?
Yeah. Let's talk about the second one first. They of course would be impacted if the macro gets worse in general, but I think they are pretty resilient. Most of their revenue goes towards food products or hygiene products, perfumes. So it's not the first thing people would cut. And especially with a higher focus than competition on premium products, I would, for example, assume that customers who buy MS are less affected than people going to cheap brands.
Good point. Agree.
And then to competition. Of course, if more money flows in, they will get competition. But the good thing is that M&A is a part of the business, but most of the growth still is organic. And especially with the barriers to entry and also the localized ingredients in many cases, they are advantaged against the competition. But of course, they can get more competition and will have a tougher time. But I also think they have a different investment time horizon than some competitors, and maybe some, for example, vertical integration investments wouldn't be worth it if you look at a quarterly or annual target you have. And then also regarding acquisition, like them getting acquired potentially, I don't think that will happen, especially after the two competitors are not owners anymore. And also some interesting fact is I don't remember if it was 22 or 21, they did a 10% buyback of shares. This was mainly done to buy out members of the Maubert family who did not want to stay invested in the company, because they feared that they would run to competitors like Givaudan who were building a stake at that time. So they are trying actively to keep the ownership within the company. As you can imagine, it's a 170-year legacy. It's not just one or two people who have this ownership. The Maubert family is big, and it's not in full unison. So I guess that would be a somewhat of a risk. But as of now, they have the majority of ownership, and I don't think that will change. They would probably rather buy out family members than let them sell their voting rights.
Yeah, perhaps, yeah. And then switching over to the opportunities, let me name the two I have, and you can either add to it or disagree, perhaps. The first one I have to say is they have very strong ESG tailwinds. I mean, we have to go greener. We have to go healthier. There's a lot of nonsense in our food, in our health, in products. I mean, you can't deny this, that their tailwinds to more natural, clean label ingredients is massive, and they are jumping in on this. They are all in on this. So I really like this tailwind, and I think they have a very high chance of growing for a long time, very steadily. And the industry is consolidating. And besides getting acquired, I don't think this is likely at all, like you said. But the more the market is consolidating, the higher the margins should eventually go. If the market is going to get dominated by 10 players, let's say.
Yeah, Robertet definitely is benefiting from the secular shifts. And I think we will also see some parts of the flavors and fragrance industry shifting from more chemical solutions to more natural solutions. And Robertet is well positioned to continue thriving because of that. I mean, they have been natural for all of their life, so it's not like they are shifting towards it and trying to look clean. They are clean. And then also what I would add is AI. As I said, it's a double-edged sword. It could make R&D more effective and cheaper. So maybe we will see some decline in R&D spending as a percentage, but maybe it will get more efficient. That could be a tailwind to margins, but that's just a more speculative opportunity. And then also I would see international expansion as an advantage. They are still a small business. Even though they are global, it's still a large opportunity to go to more countries, and especially in the Asian region as the middle class grows there is an opportunity for Robertet, especially with the more premium focus to get a bigger business in those parts of the world as well.
Yeah, good add-on, I believe. And I just had a little inside joke, I just tell the men, I can just see all these people from the R&D opening ChatGPT and then playing around with all these flavors, and I don't know.
Yeah, probably some more sophisticated way. But,
yeah, just an inside joke. I think this would be a good time to head on over to the valuation, where it all comes together. After doing some research, I found out that Robertet is cheaper than all of its competitors. So is the market missing something? Are we missing something? Or is there something else going on? What is your feeling about the valuation?
Yeah, it's something that puzzled me as well. I mean, it's still not a very cheap business. It's a very resilient market and with good tailwinds. So you have generally high valuation multiples. During COVID, prices ran sky high. I think Robertet traded at like 40 times earnings, which I think is a ridiculous price for them. Some reasons I could see is that they are a lot smaller, and for that reason, indexes are not buying them as much. I think that's a big part, especially in recent years, that large caps are getting a bit higher while small caps are getting ignored. Then we also have their reluctance to sell the business. I think some people would have liked them to sell it, especially with competitors owning 30% at some point, I think it was. They would probably have liked the additional upside for a buyout. I think those are some reasons. And also just in the recent year, French equities in general have had a pretty tough time with the whole uncertainties about the government. And I think that also plays a role.
Yeah, I think it doesn't help operating in Europe right now. It's America first, like Trump always says. So I think that is partly the reason for the lower valuation. We always use a scenario analysis. We feel it's just a good way to get a feel for the valuation. And if we assume 8% growth and then dropping it down each year with a 12% profit margin and an exit multiple of 15, which I find pretty low, we arrive at around an 8% IRR, which excludes dividends, but it isn't market beating. But at the same time, I don't know. I don't know how I feel about this valuation. What is your view on it?
Yeah, I look at valuation most of the time in an IRR model, also with like a bear, a base, and a bull case. I think they should be able to grow between 5 and 10%. I think the margin will either stay at the same level or increase. And I include dividends because I think it's important to include them. On the exit multiple, I agree that it's currently cheap. It's 12 times forward EBITDA. So I think that would be the base level. I don't see it dropping really lower, but I could see it being materially higher. So I get an IRR range between 4 and 20%, depending on multiples expanding. And so on a fundamental basis, I think they should increase intrinsic value by between 5 and 11%. So on average, I would assume the IRR could be around 11%, if especially if the bull case materializes and valuation re-rates in line with the industry. But of course, we could also see the negative case where the industry just rates down, aligning with Robertet. But I feel, even though it's not one of the higher IRRs in my portfolio, I think it's a good risk reward looking at the longevity of the business. It's one of those businesses where basically I bought it thinking that I would probably be able to still own it in like 10 or 20 years without thinking about it too much. This is a business that will most likely outlive myself and basically all of the viewers here, I would guess. I see very little reasons for them to stop existing.
Yeah.
So the longevity, and especially with the tailwinds they should be able to continue growing at a decent pace above inflation for a long time. So.
Yeah, I think when we talked beforehand, you said, and it stuck with me, but it's a company you buy and forget about.
Yeah.
I don't think this company is gone in 20 years. I think it will still be around. I think it will be larger than today. I think revenue will grow. I think their market share will increase. There is a lot to like you said. It's family owned. The Lindy effect comes into play. I mean, it's such a small percentage of the customer's products that there is not really an incentive to switch. They have a tailwind, an ESG tailwind. There is a lot to like, and I would love to own a company like this. I told you my conclusion is I like the business, but I need to do some more research on the industry. So perhaps I'm going to analyze a few other businesses within this industry. Who knows? I just need to understand the dynamics and what makes each company unique. What are you going to do with Robertet? I think you own it. Are you going to hold it? Are you going to increase it? When would you sell this company?
Yeah, so I own the company. It's not a very large percentage of my portfolio. I think it's around 3%. I recently bought some more as the company traded down a bit to the lower 800 euro region. I think I bought it like 830 euros. It was mainly because I got some inflows from a large position I sold. Yeah, I will definitely continue to hold the company. I won't make the percentage in my portfolio a lot higher. I think while it's a great business, it's one of those businesses where I'm very valuation sensitive. It's not that I expect a very high outperformance on the revenue growth. I don't think they will suddenly be able to grow 15% a year. I think they will be within the 5 to 10% range. And with those kind of businesses, I want to buy them cheap. And while they aren't super cheap, I think they are at a pretty fair multiple. So I have been happy to increase my stake a bit, and I will continue to own it. Regarding reasons why I would sell them, one thing that would definitely be a big red flag is if there were large scandals, especially with their focus on sustainability and the naturals. They, for example, shouldn't have suddenly a child labor scandal or something. That would be basically a thesis-breaking thing. Then also if it would be starting to get clear that people stop caring for sustainability and those tailwinds would go away, that would make it a lot tougher to underwrite higher or like the 5 to 10% revenue growth.
I don't see that happening though.
Yeah, me neither, but it's a thing that
reason
would
to sell.
Break the thesis, yeah. And then also if you would start seeing value-destructing M&A, them trying to build an empire, doing large M&A that's highly levered, for example, and all the kind of empire building managers tend to do. Doesn't look like it, but maybe they change the CEO in a couple of years and it gets worse. I don't know. It's something to keep in mind. Not something I find likely, but yeah. And then obviously, if there is, for example, a very high re-rating and the company trades at 40 times again, I would probably also sell. But yeah. I try to not sell winners too much, but especially with lower revenue growth businesses, if they get too expensive, it's hard for me to hold on.
Great conclusion. I mean, it's pretty similar to mine, but you own it. You've been investing in this company for a lot longer than I have. I would love to just visit one of these research and development centers, like one of these factories. I would be so interested to see what is going on there, just to get a feel of, I asked
interesting.
Yeah, I asked investor relations if I believe there's one in Belgium or like top of France. So I asked if I could, if I could come over and just look around, but I never got a response. But who knows, if they listen to this audio analysis, they will let me.
Yeah, it would be definitely interesting to see a factory, because most of the different ingredients have different procedures to get the final product. So it wouldn't be a factory with like the same machine placed there 50 times in a row. So I would imagine it to look very interesting.
Hey, Nicholas, we said let's try to keep it under an hour, and I think we did it, which is pretty impressive. I am usually pretty long on the information side. Thank you for keeping me restrained here. I think the listeners will have a very good understanding of this business. Where can people find you?
Yeah, people can find me on Substack at Heavy Moat Investments, and also on Twitter with the same name.
If you'd like another analysis done by Nicholas and I, just let us know through email or just letting a comment below. That would be lovely to know. I would like to thank you for having you on and sharing your insights and thoughts on this company. I absolutely loved analyzing this company. It was a lot of fun. I learned a lot of new insights on this industry and this company. So thank you for that. Would you like to say the final closing thoughts on this analysis?
Putting so much pressure on me. Thank you for having me. It was a lot of fun. And of course, I would be delighted to do one more. If you check out my Substack, my portfolio is public. So you can check out my companies, and maybe there is an interesting one we could talk about, which maybe you guys haven't analyzed yet. So I mean, we'll see what the future brings. I would be happy to be back again.
Awesome. Well, thank you for listening, and hopefully we'll see you in the next one. Bye, everybody.